Hey everyone, welcome back to The Explainer. Today, we are diving into something absolutely crucial, a strategy that literally changes how businesses operate, survive, and thrive. We're going to unpack the ultimate blueprint for restructuring your debt and unlocking hidden capital that might be sitting right in front of you on the warehouse floor. If you're looking to optimize your corporate cash flow, avoid some pretty catastrophic financial pitfalls, and legally maximize your tax benefits, this is an absolutely must-know topic. Let me ask you something right off the bat. Are you funding a 10-year asset with a 1-year loan? I know, right? Saying it out loud, it sounds kind of crazy. But the reality is, so many financial managers and business owners unknowingly fall into this exact, highly dangerous financial mismatch trap. And it's a trap that can literally sink a thriving business overnight. Well, this exact trap is what we call rollover risk. It's essentially the danger of your short-term loans coming due, maturing, and suddenly, maybe because of an economic downturn, they aren't renewed long before the asset they actually bought is paid off. It's basically a ticking time bomb. If lending tightens up because of market uncertainty, your business is suddenly unable to roll over that temporary loan. And that sudden, severe cash flow crunch, it forces businesses to sell off equity at terrible prices, or worse, face bankruptcy. Okay, let's dive into our roadmap for today. We're going to start with 1, the rollover risk trap. Then 2, the maturity matching principle. 3, temporary versus permanent financing. 4, unlocking equipment equity. And finally 5, maximizing interest tax deductions. Section 1, the rollover risk trap. A ticking time bomb. So most of the time, mismatching these loan lengths doesn't cause an immediate panic, right? Lenders keep lending, businesses keep running. But in the finance world, using short-term temporary lines of credit to fund long-term assets is known as pulling the line down. Managers do it because, hey, short-term loans usually have lower interest rates. But here's the catch. It only takes one tiny market hiccup for lenders to pull back. You know the old joke, right? A bank is a place that will gladly lend you an umbrella in fair weather and ask for it back the second it begins to rain. If your lender suddenly refuses to renew that financing, your cash flow completely freezes. In fact, institutions know this is so risky, they often force companies to pay down their temporary financing to zero at least once a year. They call it an annual cleanup, just to prevent this from happening. Moving on to Section 2, the maturity matching principle, the core theory. So, how do we actually fix this mismatch? Well, what's really interesting about this is how simple yet incredibly powerful the answer is. The maturity matching principle basically says that the life of an asset and the length of the loan you use to finance it should be approximately equal. Boom, that completely solves the rollover trap. Think about it. If you buy a piece of equipment with a 10-year lifespan, you fund it with a 10-year term loan. Why? Because over those 10 years, that asset is actively generating cash flow for your business. By matching up the terms, you create what's called a self-liquidating debt. The asset literally pays for its own financing over its useful life. Now, out in the real world, companies use different policies depending on their appetite for risk. Take our restrictive policy, for instance. That's using temporary financing for your seasonal needs. You get lower interest costs, sure, but that rollover risk we just talked about, sky high. On the flip side, you've got a flexible policy, which uses permanent financing for practically everything. The risk is super low, but you are paying much higher interest costs, basically pushing the line up where excess funds just sit there in low-yielding accounts. Most companies end up finding a compromise policy, mixing temporary and permanent debt to balance moderate risk with moderate costs. But the absolutely crucial point here is understanding exactly which strategy your business is using right now. Which brings us to Section 3, temporary versus permanent financing, the showdown. Let's compare the actual levers you can pull today. Think about traditional working capital loans. They are totally notorious for sky-high interest rates and those brutal, frequent, often weekly payments. It just aggressively strains your cash flow and forces you into this endless cycle of frequent renewals and constant debt. Now, contrast that with equipment refinancing. According to lenders like Axe Business Funding, converting that debt into equipment refinancing gets you lower interest rates, fixed monthly payments, and real predictable stability. You're actually using the equity of the asset you already own to free yourself from the crushing weekly burden of short-term loans. And get this, the leverage you can achieve with equipment financing over other permanent loans, like commercial mortgages, is fascinating. Take Canada, for example. The Bank Act there limits commercial real estate loans to 75% of the asset's value. They do that to create this massive buffer to stabilize the financial system, just in case real estate tanks in a recession. But term loans for equipment? Financial sources show companies can typically borrow up to 80% of the value of new assets. 80%! That is just incredible leverage when you think about it.
All right, Section 4, Unlocking Equipment Equity, the escape plan.
So there are some really incredible strategic benefits here, especially when we look at real-world insights from specialized lenders like Texas Gulf Bank and Axe Business Funding. Get this, even if your equipment is completely paid off, you can still refinance it. Doing that gives you immediate access to working capital to go after new growth. Plus, by extending the term or negotiating a lower rate, you secure significantly lower monthly payments. You can consolidate multiple debts into one simple payment. You can improve your loan terms, say goodbye to those dangerous balloon payments. And you do all of this without sacrificing one bit of your daily operational efficiency. Your heavy machinery isn't just tools, it's literally hidden capital waiting to be unlocked.
And that leads us perfectly into Section 5, Maximizing Interest Tax Deductions, the aha moment.
Now, this insight right here from PKF O'Connor Davies is a total paradigm shift. Listen to this. Tax deductibility is determined by how loan proceeds are ultimately used, not how they're collateralized. These are known as the interest tracing rules. So if you take out a business loan secured by your personal home or you refinance heavy business equipment, the tax authority honestly doesn't care about the collateral. They only care about where the cash ultimately went. If those funds are used directly for your professional activity, the interest could be entirely tax deductible. But, and this is a big but, you absolutely have to follow the rules perfectly. According to tax specialist Seth Millett, there are 3 exact steps you have to hit. Step 1, you must have a genuine borrowing relationship, meaning no informal handshake agreements. It's got to be a real legal obligation. Step 2, there has to be a direct link proving the funds were used in the business. And step 3, the Supreme Court actually requires a reasonable expectation of income. You must prove you use those borrowed funds to generate business or property income. It's the current, actual use of the money that counts, nothing else. Now, here is where it gets really fun. There's this fascinating provision called the 30-day interest tracing rule, and it gives you massive flexibility. Imagine you use cash straight from your account to buy some stock or an asset. 20 days later, you get a loan and drop those proceeds into that exact same account. Well, under this 30-day rule, you can actually treat your earlier purchase as if it was made from those new loan proceeds. Even though you bought the asset before the loan even cleared, as long as it's within that 30-day window, you can categorize a portion of the interest as a deductible expense. Proper planning here unlocks substantial tax benefits that most businesses completely overlook. So what does this all mean for us? The absolutely crucial point is this. Look at your balance sheet today. Seriously, take a look. Are you unknowingly committing the cardinal sin of maturity mismatching? Are you suffering under high-interest weekly working capital loans when you could literally be utilizing fixed-rate equipment refinancing? Are you leaving hidden capital locked away inside your machinery and massive tax deductions on the table simply because you didn't trace the interest correctly? The strategies are right there. The rules are clear. It is time to restructure, unlock your capital, and optimize your cash flow. Thank you so much for joining me for this explainer. I really hope this helps you completely rethink your corporate debt.